Let me ask you a question that took years to answer. Have you ever taken a trade even when the market was clearly moving against you? You saw the rejection, you saw the momentum weakening, you saw the price failing to continue, yet you still entered because you believed the market would eventually turn. But instead of reversing, the price just kept moving against you, and slowly that red number got bigger and bigger. Let me describe exactly what happened inside your mind at that moment. You stopped reading the price objectively. You stopped reacting to new information. You started hoping. And the moment you start hoping, you stop trading, because now you are no longer trading the market, you're trading your own opinion. This is one of the most dangerous traps in trading, not because your initial analysis was wrong, but because your ego became attached to it. The market was giving you new information. The price action was telling a completely different story. Yet instead of adjusting, you waited for the market to prove you right. Let me tell you a hard truth that separates the traders who survive from the ones who lose it all. The market does not care about your opinion. It only rewards objectivity. Professional traders understand this deeply. They do not try to predict what will happen next. Instead, they prepare for multiple outcomes, and they simply react to what the market actually does. Because in trading, certainty is an illusion. Absolutely anything can happen. And once you truly accept this, you stop predicting and you start trading probabilities. Let me walk you through exactly why your brain becomes biased in the first place. We are going to uncover how this bias forms before you even open your charts, the physical signs that you are trading with bias, and the exact blueprint professional traders use to remain completely neutral. Because once you remove the emotional bias, you stop trading what you think, and you start trading exactly what you see. To truly understand this trap, we must first look deeper into the architecture of your brain. Because what happened in that losing moment was not just emotional, it was neurological. When the market started moving against your position, your brain did not see it as a chart changing direction. It saw it as a loss of control. And for the human brain, a loss of control equals a literal threat to your survival. The moment that happens, a very specific system activates, the amygdala. This is the part of your brain responsible for keeping you alive, the exact same system that reacts when you are in physical danger. And here is the fatal problem. The amygdala does not understand trading. It does not understand probabilities, risk management, or that a small loss is simply part of the business. All it understands is that something is wrong and you need to fix it. The moment that signal fires, your body shifts into a fight or flight response. Your heart rate increases, your breathing becomes shallow, your focus becomes completely narrow. Most importantly, the part of your brain responsible for logic, your prefrontal cortex, actually starts to shut down. This is why you can know exactly what to do and still fail to do it. You are not dealing with a lack of knowledge, you are dealing with a biological override. Now, we must layer something else on top of this survival response: dopamine. Every time you anticipate a winning trade, your brain releases dopamine. This happens not when you win, but when you expect to win. That anticipation creates attachment. You start visualizing the move, the profit, the validation, and the moment price moves against you, that expectation collapses. Your brain desperately wants to recover that feeling, and it wants it quickly. This chemical craving is exactly where revenge trading comes from. This is where overtrading begins, and this is exactly why traders stubbornly hold losing positions. Exiting the trade means accepting the loss, not just financially, but chemically. Your brain resists that discomfort, so instead of cutting the trade, you delay, you justify, you hope, not because it makes logical sense, but because your biology is trying to protect you. This is the foundation of bias. It is built into your biology, and until you understand this, you will keep thinking your problem is your strategy. Understanding the biology is only the first step, because this biological shift does not start when you enter the trade. Bias actually forms much earlier, long before the market even opens. Let me show you how it quietly takes over. You wake up and check the market. Maybe you read some financial news or watch a quick video. Someone confidently declares the market is going higher today. Without even realizing it, your brain forms a direction. You tell yourself the market looks strong, a breakout is coming. At this exact moment, nothing is inherently wrong. Having a hypothesis is normal, but a massive psychological shift happens next. The moment that idea forms, your brain stops searching for the truth. It starts searching for confirmation. You open your chart and suddenly everything begins to align with your pre-market idea. Bullish candles stand out clearly. Pullbacks look like massive opportunities. Weakness becomes incredibly easy to ignore. The chart did not change. Your perception did. Your brain is automatically filtering reality for you. To make matters worse, anchoring takes hold. Once you have an idea, your brain attaches itself to a reference point, like yesterday's high or a key technical level. Everything now revolves around that anchor. Even if the market structure starts violently changing, you keep returning to that point, telling yourself it should hold or it will bounce. Notice the language. You are focusing on what the market should do rather than what it is actually doing. That is where objectivity breaks. The more time you spend analyzing this idea, the more you want the market to confirm your intelligence. You are no longer evaluating a trade setup, you're protecting a belief. By the time you finally enter the trade, your mind is no longer neutral. You're already heavily leaning in one direction. This is why adjusting to new market data feels so uncomfortable. You're not just closing a trade, you're forcing your ego to admit it was wrong.
This realization leads us to the ultimate divide in trading. Up until now, you might still believe this is just about fixing a few behavioral mistakes, like cutting losses faster or being more disciplined. But the truth is, this is about a complete shift in identity. A biased trader operates under a very simple delusion. They believe their job is to predict the future and be right. They believe that if they analyze the charts deeply enough, the trade is guaranteed to work. When it inevitably does not, they do not question their setup. They question the market. They call it manipulation or claim the move makes no sense. They resist the market because their identity is tied directly to being correct. A loss feels like a personal failure, which creates massive internal pressure to hold and justify the bad position. Now, compare that to a professional. A neutral trader does not see the market as a puzzle to be solved or a future to be predicted. They see it as an environment of pure probabilities. They do not enter the market with certainty. They enter with conditions and scenarios. Most importantly, they are completely comfortable being wrong. For the professional, being wrong is not a failure. It is simply data. It is feedback. When the market moves against their position, there is no internal conflict, no hesitation. They simply recognize that the condition for the trade is no longer valid, and they exit immediately. They execute cleanly, without emotion, not because they possess superhuman discipline, but because they accepted the risk completely before they ever clicked buy. They already knew the trade might fail. This shift in identity removes the ego, removes the pressure, and leaves you perfectly aligned with the market.
So, how do we catch this shift before the damage is done? Understanding neutrality is easy in theory, but detecting bias while your money is actively on the line is a completely different challenge. Bias does not announce itself, it builds quietly. You must start by paying strict attention to your own body because your physiology will react long before your conscious mind catches up. When the amygdala begins to take over, your heart rate spikes, your breathing turns shallow, your jaw tightens. You develop tunnel vision, staring obsessively at your floating profit and loss or a single 1-minute candle, entirely losing sight of the higher time frame structure. That physical tension is your earliest warning sign that you are entering survival mode. Once the physical signs appear, the mental justification immediately follows. Your internal dialogue shifts from observing the market to negotiating with it. You tell yourself it just needs more time or that it is just a fake-out move. You start bending your own rules, giving your stop-loss just a little more room to breathe. The moment you start negotiating with a trade, you have lost all objectivity. When you feel this biological override happening, you must activate a circuit breaker. You cannot outthink the amygdala, so you must physically reset it. When tension spikes, implement the 4-7-8 breathing technique. Inhale deeply for 4 seconds, hold it for 7, and exhale for 8. This physically forces your nervous system to calm down and brings the logical part of your brain back online. Alternatively, apply the 5-second rule. Before you ever move a stop loss or exit a trade out of fear, physically take your hand off the mouse. Count to 5. Ask yourself out loud if you are following your plan or reacting to panic. That 5-second pause is often all it takes to save your account.
Of course, catching bias in the heat of the moment is a last resort. The real work of a professional happens before the trade ever exists. Trying to control your emotions while capital is actively at risk is like trying to stay calm while your house is on fire. You must solve the problem before the fire starts. Professionals achieve this through rigorous structure. The very first thing they define is exact invalidation. Before they ever enter a trade, they know precisely where their idea is mathematically proven wrong. You must draw a literal line on your chart. This is your line in the sand. If the price crosses that specific structural level, the original thesis no longer exists. There is no interpretation. The trade is over. Secondly, professionals actively map out opposing scenarios. If they are looking for a long position, they simultaneously plan exactly what a short setup would look like. By forcing their brain to visualize both directions, they completely remove the shock factor. If the market suddenly drops, they are not paralyzed by fear because they already planned for that exact reality. Finally, they verify the trade strictly through an objective checklist. They ask themselves if the higher time frame structure actually aligns, or if they are just forcing a setup out of boredom. Being deeply honest with yourself before the entry is the only way to protect your capital from your own ego. By making all the difficult decisions before the capital is deployed, the professional trader removes the need to make emotional choices under pressure.
Yet, even with a strict plan and a line drawn in the sand, interference often creeps in once the trade goes live. This is where most traders quietly destroy their edge. Once you have a position open, your focus shifts from reading the market to interacting with your own money. Every tiny fluctuation suddenly carries personal meaning. If the price moves slightly against you, it feels agonizing. If it moves in your favor, you feel an overwhelming urge to close it and secure the profit. You start making micro adjustments based entirely on feelings, exiting early or moving targets. Consider a classic technical setup like the bull flag. You buy the consolidation expecting a massive breakout higher, but suddenly the price slices down through the bottom of the flag on heavy selling volume. The biased trader ignores this glaring structural failure. They call it a liquidity sweep. They hold onto the position hoping the flag magically repairs itself, eventually riding a massive loss all the way down. The neutral trader sees the exact same heavy volume breakdown and recognizes the pattern is instantly void. They do not negotiate. They take the small planned loss and walk away. Once your trade is placed, your job is completely finished. You are not there to micromanage the market. You are there to let the probabilities play out. Better trading results do not come from making brilliant decisions in the heat of the moment. They come from making far fewer decisions while under pressure. When you stop interfering, your trading finally becomes consistent. To bring all of this together, you must build a daily system that makes emotional interference statistically irrelevant. You know the theory, but without a mechanical framework, your brain will revert to its old habits tomorrow morning. Your new system starts with mandatory position sizing. You must strictly cap your risk at 1 to 2% of your total capital per trade. By keeping the financial risk mathematically small, you prevent the amygdala from ever perceiving a loss as a fatal threat. A 1% loss cannot trigger a survival response. Proper sizing is the ultimate shield against emotional hijacking. Next, every single trade must begin with one definitive question. What exact price level proves me wrong? Define your line in the sand. Place your hard stop loss at that level in your broker and accept the risk completely. Once the order is filled, you shift into pure execution mode. If the structure remains valid, you stay in. If your invalidation line is breached, you exit without a second thought. Finally, you must permanently change how you evaluate your own success. Stop looking at your daily profit
and loss to determine if you are a good trader. A brilliant, highly disciplined trade can lose money due to market randomness. A terrible, impulsive revenge trade can occasionally win. Measure your success exclusively on your ability to follow your process. Did you respect your stop loss? Did you size appropriately? Did you avoid interfering? If yes, it was a flawless trade, regardless of the financial outcome. Structure, not willpower, is the true secret to long-term survival.
Ultimately, implementing this system requires a fundamental choice. You now have the information. You know exactly how your biology works against you, how bias filters your reality, and how to build a framework to protect yourself. The final question is simply whether you are actually willing to let go of your ego. Most traders fail because they never accept one simple truth. You are not here to be right. You are here to execute a statistical edge over time. The moment you demand to be right, you start forcing trades and defending losers. But the moment you shift your focus towards staying aligned with the market's reality, all the pressure evaporates. When you remove the deep psychological need to prove your intelligence to the market, there is nothing left to defend. Trading becomes incredibly simple. You observe the structure, you react to the data, you accept the outcome, and you move on to the next opportunity. So, the very next time you are sitting at your screens and a position starts bleeding red, take a deep breath, step back, and ask yourself the only question that matters. Am I trading exactly what I see, or am I desperately defending what I think? Your honest answer to that question will dictate the entire future of your trading career.